We've got our essentially part 4 in our series, planning for liquidity beyond the concentrated stock to next steps. On the FinTrack page, lots of resources, past events, replay videos. There's also some links as a coupon code for cash. Check it out. I got a video for you guys here. Brent posted this about a month ago. Hundreds and hundreds of likes. It's on Auntie's paper. Bottom line is single stock risk gets, with time, a single holding, and we'll let Auntie kind of comment it more, gets rough.
Somebody tweeted this chart. This is from Tax Alpha Insider, and I love it. So
what is this?
What they are showing.
Saying?
What's that?
Wait, I'm just trying to picture it.
All right,
Single stock risk grows with the holding period. Okay, go ahead.
I will open your ears. Listen to me. It's showing a distribution of returns over a 1 month period in which you get a relatively normal bell curve distribution. And then the longer out in time you go, you will see very clearly it shifts, it skews to the negative side, in which most stocks suck. Of course, you have the outliers of the world, the NVIDIAs and the Netflixes, but most stocks are not that. And so the takeaway for me is be very careful buying and holding individual stocks forever.
If you look at the median performance, that's about -8% over 10 years relative to the market. So you tend to lose to the market by about, 8 to almost 10% for over 10 years. Furthermore, if you look at stocks that have recently done well, like have done well over the past 5 years, which almost definition, if you're a high net worth individual now because you have held on to a well-performing company, you're very likely to be in this situation. Now, the future performance of those stocks that did well over the past 5 years, their median performance is actually -18% over 10 years. So that's almost 2% underperformance per year, or almost 20% over a 10-year period. So that's pretty drastic. And I'd say that's kind of the more relevant statistic to look at for most people holding these concentrated positions.
Because I think this is a really interesting takeaway from your paper. I think there's two factors there. Just make sure that I understood you right. One of them is that the stock might just go down to zero. And the second is that holding an individual position does not give you access to the few names that are going to skew the entire distribution heavily positive. Are those like the two reasons that we're going to underperform typically by holding a concentrated position?
So maybe I could just try to summarize. So how do we prepare for liquidity? So I guess borrowing some of the stuff that Chiu mentioned as well. So first of all, you got to move to a low tax state, right? Second of all, you got to start tax loss harvesting with whatever you have today. Then you continue tax loss harvesting when the liquidity actually hits, and then you really go for the jugular, right? And then you want to be donating as much to charity as you potentially can to minimize the tax bill. And so here's an example of just thinking about a starting value for a portfolio of $20 million, right? So imagine a situation, you come in, you got $20 million in cash, but you only have 6 months left in the year. So now it's June 26th. So we got exactly 6 months in the year to generate tax losses. So how much could we generate by deploying this capital into an S&P 500 tracking strategy? 250, 150. So $250 long, 150 short. So the net exposure is just S&P 500 exposure. So we look at past 6 month periods here, right? And what you can see is that obviously different market environments deliver different types of experiences. But going from the early 2022 here, the first half, that tended to be the best period. So you harvested about $18 million worth of short-term losses for this $20 million portfolio. So basically, you're offsetting the entire gain, assuming that was a zero basis position. And then even in the kind of the worst scenarios here, like the second half of 2024. You still generate over $10 million of losses. So maybe you offset about half of the tax bill. So this is why these strategies are so effective, because they help solve a problem immediately. And so we're finding a lot of traction with our clients.
We've got Erkko and Antti from Brooklyn. Had exciting news last week. Speaking of liquidity events, welcome. My name is Jason. I'm with the MIT CNC FinTrack, and none of this is financial advice. Seek a professional. This is your R&D. Let's get the MIT Club network. Let's get alumni connected up, and also friends of alumni. That's what we're here for. I'm all about tax efficiency because it's just one more layer of complexity that starts to get interesting. So you can check out past events, but the bottom line is taxes are rough. If you just go on autopilot, you can shoot yourself in the foot, whether it's individual portfolio management or broader liquidity events where you can be a little bit smarter and not shoot yourself in the foot. I've been interested in tax my whole career. My first job in '86 was as a tax preparer, and then tax rules change. Learned how that happens. Tax rules changed again in '97 when I was in asset management, when we were restructuring the portfolios for capital gain efficiency. And we're at a unique time now. Like the S curve for technology and wealth management is at a whole new place. And so we're going to hear what Erkko's been working on over there to talk about that. I'm going to turn it over to Shang to introduce everybody.
Awesome. Thank you, Jason. Yeah, and again, thanks for bringing together what an incredible rock star cast of speakers we have. As Jason mentioned, quick background on myself, class of '04 MIT. Spent my entire career post-college in financial services at both large firms as well as small firms. But really the last 5 years of my life have been focused on building thoughtful tax-aware solutions, and prior to that, also implementing them on behalf of families and individuals. As Jason mentioned, I think we're at a super exciting time right now, right? This is a point in time where a lot of these formerly sophisticated, hard to access tools and solutions are getting brought to the mass market, democratized by firms like Erkko's, which we'll get into later today. Let me just quickly touch on how the next hour or so is going to look. We'll spend about 30 minutes. Brent and I will guide the conversation with Erkko, Antti, and Chi-Yu. And then we'll start Q&A, maybe call it roughly around 12:40. So everyone, don't be bashful. Raise your hand, put questions in the chat room, and we'll get to them. Quick intros. Start off with Chi-Yu Liang. Chi-Yu is a managing director and wealth advisor at JPMorgan Private Bank. Prior to that, she was managing director at Goldman Sachs Family Office. And before that, Chi-Yu was a partner at a law firm that focused on sophisticated estate and tax planning. Chi-Yu holds a JD from UVA, an LLM from NYU, as well as an MIT undergrad degree. Next, we have two senior folks from Brooklyn Investment Group, Erkko Etula, who's the CEO and CIO. Erkko's got an incredible background, spent over a decade at Goldman Sachs creating thoughtful, systematic strategies for wealth management clients. Brooklyn, they're a cutting-edge innovator in the world of quantitative investing. Prior to that, Erkko spent his undergrad years at MIT and also has a Harvard Ph.D. Next, we have Antti Petajisto, who is head of equities at Brooklyn Investment Group. Antti's terrific. I mean, he was a former portfolio manager and Yale professor, thought leader, has authored a number of incredible white papers, including the one that we just showed, and he has a decade of investment experience in quantitative equity portfolio management, as well as an MIT Ph.D. in finance. Certainly, last but not least, my partner in crime, Brent Sullivan. If anyone's not following Tax Alpha Insider, you got to go on your social media at it. Brent's always publishing some of the most both thoughtful, educational, and entertaining ideas around tax-aware investing. Prior to that, Brent had spent time at firms like Parametric, PIMCO, and also has a Cornell master's in engineering degree. So with that, Brent, I'll turn it over to you if you want to kick things off, and we can get into the conversation.
Yeah, appreciate that, Shang. Jason, maybe we can just go through the table of contents slide. There's the one. Okay, so just very simply, the points that we're going to touch, wealth has a story, and the story starts in accumulation. And accumulation usually comes through concentration in one form or another, private, public. And then eventually, if you achieve liquidity a moment, then you want to start diversifying that portfolio. And then eventually after that, you'll start consuming the portfolio. That could be directly for living expenses. It could be intergenerational. It could be through giving plans. And then as you approach the last phase of the wealth cycle, that's preparing for estate, gifting, and then also generation skipping considerations. So those are really the four beats that we want to touch as we're making our way through all of the awesome panel and the solutions that they're going to discuss here. but that's it. Let's go through those 4 different points. And I think Sheng and Jason, you're going to talk about accumulation, hand it over to Erkko to talk about diversification and consumption.
I'm going to let you guys have a little bit more time for Q&A. Let's just wrap up the intros and get rolling. I mean, just real quick about me, wealth management, finance my whole career, client base, roughly half our revenue is people 10 million and above. In wealth management, the other mix, 1 to 10 is probably 40% of our business. So I'm all about tax efficiency. And I want to give you guys a chance to ask questions to the panelists. So yeah, Shane, you can take as much time as you want, but I'm passing it over.
Yeah, the only comment I'd add here before we jump into it, if you look at that chart that Brent just showed, the accumulation phase, Wall Street, and I use Wall Street broadly, but like they do a terrific job of helping, provide capital for startups. There's private equity firms that can help provide liquidity. There's obviously the IPO market, but Wall Street's very good at taking entrepreneurial effort, turning it into liquidity. And then on the other hand, you have the investment management industry, which also is sort of a subset of Wall Street, but they're very good with helping people diversify. But you have to start with cash, and then you go into different investment products. It really is that sort of middle ground that we're going to dive into today. Like, how do you get to that point post liquidity, and then diversification, and then into the investment products? Because that's where the journey gets a little bit hairy. You have things like tax friction, you obviously have different solutions that come into play, not just on the investment side, but you have planning and thoughtful advice from folks like Chi Yu that can really help us navigate that journey. So maybe with that, I will pause. And I don't know, Erkko, if you want to take it over and share a little bit high level of Brooklyn, and then we can go from there.
Very good. Hey, thanks so much, and great to see you all. So Brooklyn Investment Group, we are a tech-powered asset manager working really for financial advisors. We also distribute our technology to other asset managers as a SaaS solution. But you can think about us as what I would call a multi-asset direct indexing platform, and basically that means everything from equities, ETFs, mutual funds, fixed income, and on the equity side, equity long, short as well, all in a single custodian account, right? And that just creates tremendous efficiencies for our clients, who are typically financial advisors, to basically provide personalization and tax management at scale, right? And that's very important, particularly when you talk about reducing the frictions associated with client acquisition, right? So, and taxes are perhaps the number one friction for most folks out there, right? So I think maybe the best way to structure this is I got our head of equities, Antti Peragisto here. I think we could talk a little bit about the kind of the wealth accumulation and how we can get to the great levels of wealth through concentration, right? And then I'll take over and talk more about the diversification part and what are the techniques that we can use to basically help offset the tax bill that is typically associated with the sale of a company, with diversification of a concentrated position, and also very helpful in offsetting, for example, the taxes from private equity distributions, right? So all of those are kind of forms of wealth generation, and all we care about at the end is the after-tax dollar that ends in our pocket. So what we can do to reduce the tax bill, the better. So I'll hand it over to Antti first. Obviously, Antti and I, we actually go way back. Just a funny story. So we met when we were first at MIT together. I was an undergrad, Antti was a PhD student, and then we crossed paths again. Well, I was a PhD student at Harvard, and he was a professor at Yale presenting to the finance seminar there. So we've known each other for the past 20 years or so, and now have a pleasure working together at Brooklyn. And Antti obviously brings tremendous expertise from quant finance side. So not only does he do what he's going to talk about today, which is the kind of the interesting facts and features of individual stocks, but also he's got background managing long short equities at BGI, BlackRock, and other places. So we have a lot of cool signals from his prior work and the work of others that we're applying to long short portfolios today. So we'll come back to those in a little bit, but I think let's set the stage by talking about that banana chart and why it's so important.
Great. Yeah, thanks. Thanks so much, Erkko. And I'll also actually, in the interest of time, maybe I'll jump.
So we did the poll. Hopefully you guys had a chance to check it out. And like, who's here? Who's our audience, right? Did you want to see the poll, Brent?
Yeah, I'd really like to
Before we get
see it.
started with the presentation. So I can see the poll. I'll just okay. So what aspect of liquidity planning is most relevant to you today? Top pick is still concentration risk liquidity. They're combined, so those can be completely distinct. Number two, taxable investing in general. We do have some asset sale and business sale. IPO was number three. And then as far as what bucket people follow here, the top is Henry's. We got Henry's. High earnings, not rich yet. That's 31%. We've got 24% family office. I manage my own savings. Next up, no comment. And then of course we've got financial professionals, inheritance planning, separation, divorce. All these things are all part of liquidity planning. And then of course retirees listening in. They've seen many tax code changes over the years. All right. So Brent, did you want to take it from here before Auntie gets rolling?
Well, no, I mean, the only point or anything that I'd say is that I think there's maybe a surprising result in Auntie's paper, and that's that everyone knows that there's extra risk in concentration, but they might not know that there's actually a performance cost too. And I think that's a surprising and fascinating result from his work, and maybe that just cues up what he's about to talk about.
So, all right. Well, thanks for having me here. It's good to be here in front of MIT alums and other some other distinguished people in the audience. I'm actually just some months ago, in fact, I presented at another, or I gave a short speech at another MIT alum event. That was actually the MIT Sport Taekwondo reunion. So that was but that brief speech I gave focused more on other things like Bruce Lee and David Goggins. So today I'll be talking about somewhat different topics. So today I'm going to be happy to talk about this paper that I wrote some time ago. It's actually currently in the academic review process with the journal. But anyway, the paper is also on SSRN, so anyone can access it there. And I'll just, in the interest of time, I'll just kind of highlight a few key findings that may be helpful for people who are in this event or who are in this situation where they may have like a large liquidity event and focused on a single stock and they're kind of figuring out what to do with it. So let me just jump right in. Okay. So yeah, so one thing, just a couple words of background. Diversification is something that tons of people have heard about. Supposedly the only free lunch in investing. But despite the fact that pretty much everyone has heard about it, there's still quite a few people who don't really follow that advice. So individual, like retail investors, many of them hold only a handful of stocks if they hold any stock. Or they may hold a big position in their own employer's stock. And then actually even like high net worth individuals, so people who are, more kind of sophisticated as investors, many of them, this came to me as a surprise before I kind of started focusing more on kind of the wealth management issues. But the fact that, you would think that like most of these wealthy folks are kind of relatively well diversified, but actually turns out many of them are not. And of course, this is partly because, many of them are wealthy precisely because they created their wealth with a particular company. Maybe they were founders or senior employees, got equity, and have a large position as a result. But anyway, so then later on, now they've created a bunch of wealth. Now they're faced with this situation where they have a very large concentrated position, and also like the institutional investors. Even on the institutional side, there are quite a few large players that have very concentrated positions. So just actually right now, or just the statistic just came out. So today, if you look at U.S. Private foundations, about $500 million in AUM. So basically very large foundations. and very professionally managed. They still have, 70, like basically, like there's more than a dozen of those that still have virtually all of their holdings in a single stock, in one single stock. So it is definitely something that's more than more than a curiosity. It's actually it happens way more than one might imagine. So I'll just show you actually one fun example of. I mean, most of the time, of course, these are people usually don't publish their portfolios online, so you don't know what the individuals are holding, and same thing with many other private institutions. But this is a pretty public case of Emory University. This was about a little bit over 20 years ago, actually 25 years ago, in 2000, right at the tail end of the tech bubble. So very public case where Emory's endowment was in the news. There was a lot of discussion about what they should do about their positions. They had one massively concentrated position in Coca-Cola stock. Okay, and that's what this Wall Street Journal article was about in early 2000. So the basic situation is Emory had a $5 billion endowment, and over half of it was invested in a single stock, in Coca-Cola. Okay, so it's a little bit different from, if you look at, like, if you think of like the Yale and Harvard portfolios and how they're diversified across a ton of things. This was like very there's a pretty shocking level of concentration. And in fact, the reason this was in the news, and the reason there was controversy about this in early 2000, was that the stock of Coca-Cola had just dropped by about 30%. And this was about $1 billion loss for the university, 1 billion. And this is at the same time, this is only in like a year and a half. And this is at the same time when the overall market was up 30%. Okay, so it's a pretty drastic decline in the roaring bull market. And that's kind of really what prompted the question. At the same time, though, the university still seemed to be pretty happy to hold on to their position. They said, the university COO said, they were not uncomfortable holding what we hold now. We have great confidence in the future of Coca-Cola, and the target allocation to Coca-Cola stock was still, the target allocation was still 48%. So basically half of it. So anyway, so again, like very surprising in light of the usual financial advice that we hear.
Yeah, and if Auntie, I could just jump in. I mean, what's baffling about the circumstance is that they don't have tax friction. And so we're purely in behavioral territory now, where they're just holding just because they believe.
Yeah, no, absolutely. Because this is like, in fact, what they decided to hold on, they still decided to hold on to this position at the time. And one of the arguments was that, hey, it's, we're still better off. Like if we had, like when we got the gift from, this was originally from like a gift that Emory was given in 1979. And they said, like, if we had actually held on to, if we had immediately sold the Coca-Cola shares and converted into the market, we would be actually worse off than we are now with the Coca-Cola position. So that was the argument, even despite the recent loss. But anyway, so how did this anyway? So there was discussion. How did it actually play out? Well, if you look at what actually happened after this. So by the way, on the left you see like the blue line shows Coca-Cola stock. The orange line shows the market return. So this is a log scale since the time when the university got the gift. So basically January of 1980 to just a couple of years ago. And then the figure on the right shows you the performance of Coke stock relative to the market. Okay. So initially it actually soared. It was more than 400% up relative to the overall market, but then it came down quite a bit. And in fact, the red line shows kind of the time of when the article was written, when there was this controversy going on. This is when the Coke stock had dropped significantly relative to the market. And that's kind of what prompted it. But again, the university kind of decided to hold on to the position. And then actually it turns out that 5 years later, the Coca-Cola stock still declined another 25% relative to the market. And so 5 years later, they finally scaled down their position to 10%. So away from like half, now they're scaled it down to 10% of their portfolio, and have kept it there. So, and actually, if you look at kind of what happened since then, actually the Coke stock, okay, then it kind of jumped a little bit after, but then kept declining. So in fact, if they had held on to it for the following 20 years, they would have been even worse off. So it would have been better to sell right away, or like to sell earlier. But if they, but at least it was better to sell in 2005 than kind of sell in the early 2020s.
And
Now,
Auntie, that handle right there, the 10% holding, this is actually a part of your paper that I thought was really interesting. Like, how do you define concentration, and how did you choose that level of risk measurement?
Oh yeah. So in the so it's kind of, when we talk about concentrated positions, it's I figured it would be helpful to try to define it. So what I did was actually looked at portfolios of equity portfolios. You have typically some level of kind of market risk and some level of kind of stock specific risk. And then I kind of did some analysis on like at what level, when you increase the weight of a stock in a portfolio, at what level does does that stock specific risk really kind of pop up? Whereas like, that's, it turns out that's, you get really good diversification if the position is, up to a couple of percent, even 5%, it's still pretty good diversification. But when the stock position reaches about 10%, that's when it really starts to have an impact on the overall portfolio, and obviously above that. So of course there's no like clear cutoff, like it's kind of, but it's kind of like a ballpark of where things really start to matter once you kind of cross that 10% threshold. So yeah. Cool. And by the way, there also, like, this may be kind of an interesting anecdote per se, but some people at this point may be thinking like, hey, maybe Emory was just unlucky with maybe this is a coin toss. Emory was just unlucky with their Coca-Cola holdings, and this just happens to be a stock that actually went down. No, in fact, this is a typical outcome. It's not just bad luck. This is a typical outcome. So the median stock is not flat relative to the market. The median stock actually goes down relative to the market. And that's the important, so that's actually a very important point that I want to emphasize. So in fact, this is kind of more like the typical outcome that we're seeing here in this Emory example. So in fact, so this comes down to the charts that also like Brent has talked about and illustrated. So the idea is that when you look at, if you look at like in stock returns, I'm actually showing you the stock return distribution for various horizons. So the top left is the 1 month return. At the middle of the middle here, top middle is the top middle is the 1 year, and then 5-year horizon, and then 10-year, and finally 20-year horizon. So what you see is that, okay, 1 month horizon stock returns indeed are basically a coin toss. It's essentially basically a normal distribution. It's more or less symmetric. 1 year horizon, it's still pretty close to symmetric. But then you look at 5-year horizon, it actually starts to start to see this like skewness pop up. And then that you go to 10 years, and especially look at 20 years, that's obviously far from a symmetric distribution. So you start seeing actually two things. So you see at the left tail, you see some of this big bar here for the 20-year horizon. You see that a bunch of companies have basically had a minus 100% return, or close to a minus 100% return. So they went out of business, or at least mostly lost their business. That's the big bar here on the left. But then at the other, like the right tail, there's a handful of, not many, but there's a handful of companies that had just phenomenal returns. We're talking about like hundreds of percent. And by the way, this is relative to the overall market. So they beat the market by several 100% over a 20-year period. So the thing is, there are, of course, the market itself is an average, just an average return, but it's a cap-weighted average of all these stocks. But the important thing is that the relatively high returns on the market are really driven by just a small number of complete outliers of like very high performers, whereas the median stock has actually underperformed. But when we consider this, if you're holding a concentrated stock position, that's important to keep in mind, because basically if your median return is negative, that's something you probably want to be aware of. So the final thing I want to point out here in terms of numbers is that if you look at the median performance, that's about minus 8% over 10 years relative to the market. So you tend to lose to the market by about 8 to almost 10% for over 10 years. And if you actually look at furthermore, if you look at stocks that have recently done well, like have done well over the past 5 years, which almost definition, if you're a high net worth individual now because you have held on to a good well-performing company, you're very likely to be in this situation. Now, the future performance of those stocks that did well over the past 5 years, their median performance is actually minus 18% over 10 years. So that's almost 2% underperformance per year, or almost 20% over a 10-year period. So that's pretty drastic. And I'd say that's kind of the more relevant statistic to look at for most people holding these concentrated positions. So basically that's kind of like a performance drag that you're facing for the median stock, that if you're holding a concentrated position. Now, final slide, why do people still hold concentrated positions? There's tax. You have a couple of rational reasons, like taxes and corporate control. Maybe you want to maintain control of the company, then you kind of need to hold equity in it. Also taxes, a lot of people have given that as a reason, and we'll talk about that in a second. But there's also like lots of these behavioral reasons, basically essentially not fully rational reasons to hold on to that. And in the case of Emory, like Brent was highlighting, the university, of course, is tax exempt, so there's no reason for them to hold a concentrated position for that reason. And they probably didn't want to control the Coca-Cola, have like significant voting power in Coca-Cola either. So in that case, it was more likely I mean, there's like loyalty to the firm, like to the donations of getting those shares, and also just like the stock had done well for a while, so just kind of basically extrapolating that previous performance and also just like taking action. Basically, if the default action is the default is not to do anything, so selling out of a 50% position might be viewed as kind of like the active view. And it may be easier to kind of stay with the status quo. Anyway, so those are kind of some results.
Andy, if I could just jump in here. Yeah. For sure. Like if you had to give like the summarizing point, because I think this is a really interesting takeaway from your paper, just like what are the two factors that cause just a randomly chosen stock to underperform the broad market? I think there's two factors there. Just make sure that I understood you right. One of them is that the stock might just actually just go down to zero. And the second is that holding an individual position does not give you access to the few names that are going to skew the entire distribution heavily positive. Are those like the two reasons that we're going to underperform typically by holding a concentrated position?
Yeah, I mean, I'd say it's really about the positive skewness of the distribution, especially when you hold a stock for many, many years. And that's I'd say it's really, so it's particularly the second reason that you mentioned about the fact that if you hold just one stock, sure, I mean, you may get extremely lucky. Maybe you're holding one of these like stocks that go up like 1,000%, but the chances, if you look at like what the distribution of outcomes is, the most likely outcome is that, I mean, typically that you'll get something similar to the median performance, which actually will be negative. It will underperform the market so that's really the problem. So of course, I mean, if you want to like gamble on this, then you could get lucky, but I think it's most investors really only care about if you look at the majority of outcomes, they tend to be in this negative territory or relative to the market.
So the natural question is, and this is a good transition to Erkko, is like, what do we do about this? Is there a graceful way to transition a concentrated position or to proactively prepare for a liquidity event with taxation, but also behavioral factors in mind? And I'll just hand it over to Erkko for some thoughts on that.
Yeah, very good. So this is kind of where the rubber starts meeting a road. So now, Anti's described how folks become wealthy, and now we want to make sure that you stay wealthy. So how do we basically manage the risk or reduce those concentrations in the most effective way possible, right? And there are a number of tools that are at our disposal. You may have obviously heard about exchange funds, where you would put the stock in a fund for 7 years and leave it there. That's one way to do it. There are costs involved with that, and also you essentially lose control of the stock, right? The ways that we help our clients diversify concentrated stock is by putting what we call long short extensions on them. So basically generate tax losses in a very rapid way to help reduce the concentrated stock by basically paying off the gains, right? So offsetting the gains with the losses that are generated through the long short extension. And maybe I'll just to give you that visual here as well, because I know there were some previous sessions on this, but I think it's always helpful to kind of remind everybody how it works. So this is essentially how it works. So you start with your I guess let's take the Coca-Cola stock as an example from the Emory study. And you start with that. That's $100 there. So you can basically fund a program using an individual security. And that's what we're doing here. And then we put a 30% long extension, which consists of about 200 to 400 individual stocks. So it's a long portfolio, diversified long portfolio of stocks. And then we offset any market exposure, any factor exposures, any additional risk exposures through the short extension here. And that just makes sure that like when market is moving up or down as a whole, the long short extension doesn't really change in value, right? The purpose of the extension is twofold. One is to generate those tax losses. So now essentially we've created what I'd like to call sort of phantom cash. So we expanded the size of the portfolio, and now we can do tax loss harvesting in the blue parts there, right? And the second purpose is to generate some additional return. And again, that latter part is very important for the IRS, because IRS doesn't want us to run tax arbitrage strategies. So like there has to be some economic rationale for selecting the longs and the shorts, and I'll talk about that in a second. But what is very neat about the long short extension is that number one, you don't need any cash to get that started, right? So you just post a stock that you have as collateral. And then the negative side of this trade is negatively correlated to the market, right? So as markets generally tend to go up over time, you're actually consistently harvesting losses through that negative exposure. So unlike in your long only tax loss harvesting strategies where the market values of the stocks tend to run away from the cost basis, now that short position basically makes sure that you can consistently keep harvesting losses as market rally. So in principle, these long short strategies can generate tax losses indefinitely, right? So that's a really, really neat part about them. And obviously, you don't need to run a 130-30 strategy. You could ramp up, leverage and go all the way to 250, 150, or 300, 200. So basically, the amount of tax losses that you're generating scales approximately linearly. The downside of that is that there's some more tracking error there. But in this example that I'm giving you here, so the first year you're racking up about in the 130-30 solution about 20% in short-term losses, and then you're ramping it up to about 60% if you do a 250-150 type strategy. So you can now start imagining how you can use those losses to offset the gains in that single stock, which is kind of the primary use case of most of these strategies. In fact, if you look at an example for a concentrated position sell down, so we do a lot of these sort of custom work. Here's just an example for a Meta stock. So a client came in with a zero cost basis position in Meta, right? And that's all they had. And we put just a 130-30 extension on it. And depending on how you treat the long and the short-term tax rates, it takes about 4 to 5 years to sell down that position to zero, right? And this is an extreme case where it was a zero cost basis position. Now, ramp up leverage to 250, 150, this whole thing is typically over within a year, right? So that's kind of like how we have this tool that can be used to scale up and down the amount of tax losses, and we can use them to then diversify these concentrated positions. Now, so that's sort of use case number one, concentrated position sell down. The two other use cases, again, in the spirit of preparing for liquidity, is obviously liquidity events. So sale of a business. And typically the founders of businesses, they have a pretty good understanding as to, the time horizon at which they'd like to liquidate or realize those gains. And it makes sense to get started as soon as possible, right? And before the liquidity events, many founders don't have that much cash, right? But what you can do is to basically come to us and basically post any marginable securities that you may have. So your ETFs, mutual funds, single stocks, whatever there is, as long as that's $500,000 or more, and then we can start this loss harvesting process. We don't have to touch any of those securities, right? We just need to hold them as collateral, and then we do a long short extension on top of it to start the loss generation process. And as you know, those tax credits or tax losses can be carried forward forever. So whenever the liquidity event actually happens, then you've accumulated this good chunk of tax losses to offset those gains. And obviously, when the actual liquidity event does happen, then that cash can be deployed in this program. And I'll just show you an example that we just recently ran. And obviously, as Shang and Jason mentioned, many Brooklynites also went through or are going through a liquidity event in the coming weeks as we announced our acquisition. So we've obviously been preparing for this liquidity for some time, and so here's an example of just thinking about a starting value for a portfolio of $20 million, right? So imagine a situation, you come in, you got $20 million in cash, but you only have 6 months left in the year. So now it's June 26th. So we got exactly 6 months in the year to generate tax losses. So how much could we generate by deploying this capital into an S&P 500 tracking strategy? 250, 150. So $250 short, $150 short, $250 long, 150 short. So the net exposure is just S&P 500 exposure. So we look at past 6 month periods here, right? And what you can see is that obviously different market environments deliver different types of experiences, but going from the early 2022 here, the first half, that tended to be the best period. So you harvested about $18 million worth of short-term losses for this $20 million portfolio. So basically you're offsetting the entire gain, assuming that was a zero basis position. And then even in the kind of the worst scenarios here, like the second half of 2024, you still generate over $10 million of losses. So maybe you offset about half of the tax bill. So this is why these strategies are so effective, because they help solve a problem immediately. And so we're finding a lot of traction with our clients.
And Erkko, if I can just jump in here, because we got to keep on moving on. I've just got one really quick question, which is when I'm thinking about the incremental risk that an investor is taking when they add long and short extensions to a portfolio, how should they be thinking about that incremental risk, and maybe just very briefly on financing cost for adding margin and shorts to the portfolio, just as sort of final thoughts on this.
Yeah, so incremental risk typically measured in tracking error relative to the benchmark. So 130-30 strategy has about 2% tracking error. A 250-150 strategy has about 9 to 10% of tracking error. Now, what does that mean? Well, if you're diversifying out of a concentrated stock, for example, those stocks typically have about 50% volatility, right? So now you're thinking about adding some single percentage points of additional volatility to that, meaning single percentage points of performance deviation from the market per year. And that's important because, like, if you think about the orders of magnitude here, on this previous chart here, we saw that you can generate tens of percentage points of tax losses, right? Now, the cost of that is that you may be deviating from the market by some single percentage points, right? And then what does that cost you in fees? Our strategies are in the tens of basis points. So 27 basis points for 130-30, 68 basis points for 250-150. So it's like you always kind of go an order of magnitude up or down. So tens of basis points of cost, and that includes then the financing costs, which if you think about a 130-30, for example, our fee is 27 basis points. Fidelity charges 30 basis points in spread cost, right? So the all-in cost to the client is 57 basis points, right? There are some commissions depending on how you're set up with Fidelity, but that's the kind of the ballpark, about 50 to 60 basis points of all-in cost. And then the benefit there is then in percentage points and tens of percentage points.
So I love this. This is breakdown here of these orders of magnitude. So the fees are in tens of basis points. Maybe just say that again very quickly. I love those order of magnitude. It's very easy to latch onto. And then we got to pass it over to Chi Yu to talk about sort of next stage.
Yeah. So again, these strategies cost end clients in tens of basis points. So 0.5%, call it, right? And that includes both our fee as well as Fidelity's spread cost, which is basically the cost of leverage, right? So that 50 basis points of 0.5% cost can help generate tens of percentage points of short-term losses. So now you're 2 orders of magnitude greater in the benefit than the actual cost. And then in single percentage points is the potential performance deviation from the market. So that's basically the risk associated with that.
And then tell me just really quickly what kind of clients you work with. You mentioned advisors. Is there an individual path too, or tell me a little bit more about who you serve?
Yeah, so our primary distribution channel is via financial advisors. So we're a B2B business, but we're thinking about setting up a direct channel as well. But if you have a financial advisor, just let them know about Brooklyn and get in touch. And as long as you're at Fidelity or Schwab, those are the 2 platforms that we offer these solutions on. We can get you up and running as soon as possible.
Okay, that's great. So we've gone through wealth accumulation and we've achieved this concentrated position, and now we've diversified. Of course, there's more ways to diversify. We'll talk to Chi Yu about that, and then after diversification into consumption and preparing for final phases. Chi Yu, I think that's a good time for you to take over. Tell us what you think.
Great. Thank you so much, Brent. So just by way of background, as Jason mentioned, I'm a former practicing trust and estates attorney. And right now, though, I'm within the JPMorgan private bank, and I work with the bank's most significant clients, including entrepreneurs, business owners.
So this comes up all the time where an investor will have accumulated, especially recently, a very, very significant position in Bitcoin. And so Bitcoin is typically ineligible for some of the tactics, exchange funds, namely variable prepaid forwards, just generally are not solutions for diversifying a Bitcoin position. Of course, you could use a charitable remainder unit trust, something like that. But also, I think there's an interesting solution with tax-aware long short. So I don't know, Erkko, if you want to give us like the 60-second, how would you quickly diversify a very substantially appreciated Bitcoin position using tax-aware long short? I think that's pretty
and
interesting.
let's be clear, it's not limited to Bitcoin, by the way. I mean, we're talking your GL, you're selling gold with a higher tax rate even than the long-term rates. You're selling real estate. I mean, this answer applies to all that.
Yeah, and I actually I better not comment on the Bitcoin question just because we are a registered entity. So our compliance officer might get me in trouble on that. So if anybody who's not registered can answer that, I think that'd be good. Or Brent, maybe you can volunteer the answer because I think you know it.
That's so funny. Yeah, okay. I'm the only one who's deliberately not registered here. I'm an independent analyst, so I get just the pleasure of investigating everyone else's solutions. But yeah, the idea is that you can actually quickly liquidate a Bitcoin position, and then in the remainder of the year with sufficient leverage, you can harvest enough losses to ideally match the gains that are realized in the Bitcoin position. And this is one, it's a creative solution. Just the things to keep in mind if you are going to liquidate very quickly is that you own the risk for a while. So there's tracking error embedded in a long short extension of a portfolio. That tracking error sustains past the diversification timeline unless you have a plan to wind down deliberately. And a long short extension just means being deliberate about estate planning. I think from the get-go, you just want to have the plan in mind. And hopefully document it just from the get-go. So again, not registered, not advice, but these are things that people tell me.
Yeah.
So we're at the hour, and I can stick around, but we want to do a firm drop off for the participants and everybody else who needs to go at 1 o'clock. But and I'll save that for the recording for later. We do have a happy hour in Mountain View coming up today, where we can talk about all the cool stuff going on. AAUS's 351 ETF exchange. Cash has something cool going on. Of course, this is even more exciting. But Shang, you want to make any closing remarks for the wrap us up, and then we'll switch over to informal.
Sure, yeah. I'll just say two quick things. I
And
think
tell us what you're doing now, because this is networking. What are you doing now since we saw you last?
Sure, yeah. So, I'm the managing partner of a family office. We trace our roots back to one of Google's first employees. And as I said earlier, myself have been building a lot of these tax-aware solutions, whether it was the Section 351 ETF transfer. I've used anything and everything from exchange funds, opportunity zones, prepaid variable forwards. I really think it's an exciting time with folks like Erkko and team, and they're building out this long, short, tax loss harvesting strategy. The one thing I wanted to say about that is I wanted to contrast that with traditional direct indexing or long only tax loss harvesting, because you bring up that phrase and people are like, oh, I know that. My Betterment account does tax loss harvesting. I think really important to differentiate that what Erkko and Antti and team are doing, so different. And I think it's really three big things. So one, it's that long short implementation. You get to win in both up and down markets. You also have a lesser chance of becoming ossified, which is what inevitably happens with every direct indexing long only portfolio, meaning all your positions have only gains. And if you ever wanted to change them, you got to pay cap gains taxes. The fact you're long and short, you have a gross exposure that's longer than just being long only. For that reason, you're going to get losses that are theoretically larger in magnitude and more consistent as well. And then last but not least, when you get to work with really smart quantitative managers, those long and short buckets are getting optimized for alpha generation, ideally. So there's the potential that you get to outperform the equity benchmark as well. So that's really nice. And then the last thing I wanted to mention was I think Brent hit on a really important point. We kind of touched on it quickly, but this notion of combining a charitable remainder unit trust where you're seeding it with, assuming you have a taxable estate, you're philanthropic, and you want to get that consistent income year over year, you can seed it with a private business, you can seed it with crypto, anything and everything within there. But once it's there, you can diversify and you can potentially actually even put it into something like a long short tax aware strategy. And then those annual income outputs that come out of there, those are assuming if they're capital gains. Oh, by the way, you got these losses that are coming off year over year. So pairs really well, like, I don't know, peanut butter and jelly, or however you like to pair your things, but could be a really interesting combination to explore more. So that's it from my end, Jason.
So maybe I could just try to summarize. So how do we prepare for liquidity? So I guess borrowing some of the stuff that Chiu mentioned as well. So first of all, you got to move to a low tax state, right? Second of all, you got to start tax loss harvesting with whatever you have today. Then you continue tax loss harvesting when the liquidity actually hits. And then you really go for the jugular, right? And then you want to be donating as much to charity as you potentially can to minimize the tax bill, right? Anything that I missed?
That sounds great right there. I did have Brent's slide where we showed all of the different use cases of this, but we'll pull that up after we wrap the event. So volunteers, raise your hand. Let's do more events like this. But we need to, it's really it's the networking. It's meeting all these people through all these linkages here. And let's, for the alums out there or the friends of the club, get involved. Reach out, FinTrack, FIN track at mitcnc.org. Let's turn off this recording.